Hi, everyone, and welcome. My name is Jon Sharon. I'm a tax partner at Richey May. Today, we're going to be talking about R&D credits with the Source Advisors team. And here I have me with the team, and I'm going to introduce you to Dave, who's going to introduce his team.
Thanks, John. I'm Dave Finley. I'm the Director of Business Development for the Midwest for Source Advisors and a CPA by trade, but thankfully I don't do much of that these days. I'm more of the client, the liaison between our firm and our CPA firm partners like Richey May and their end client. So that's my job, is to help bring our resources to bear to quantify opportunities and present them to clients. With me today is Lewis Riley, who heads up our financial services group. He is the International Director of Financial Services and quite a lot of experience in the fintech industry. About 10 years ago, he realized the opportunity to bring R&D credits to what is going on in the fintech industry. So that's his strong suit. And then lastly with us is Moy Romero. And Moy is the Senior Director of our Controversy Group. And besides having close to 20 years of technical experience directly in R&D, he heads up our controversy group. And so anytime there's an audit of an R&D credit, the buck stops with Moy. So he's got a wealth of experience in a couple of different areas there. So that's us.
Perfect. Thank you, Dave. So today we're going to talk about how the R&D credits can specifically affect the alternative investment industry and what that might mean if you're in that industry. So I guess to start it off, Lewis, tell us a little bit more about the R&D credits.
Sure. IRC 41, the credit for increasing research activities, has been around since 1981, but it was made permanent a few years ago. So it's a permanent annual benefit, and the cash tax savings can range from 5 to 10% of the amount of money that companies spend on research and development. In fintech, research and development generally means software development. So there's a lot of that going on in the fintech industry, more so now than ever. Our clients range from some of the world's largest hedge funds to startups, banks, other kinds of alternative investment companies. Uh, any company that has developers on staff is probably doing R&D. The credit can be used to offset corporate tax, or as we more commonly see in this industry, they flow through to the members or the partners of the firm. And the credits can be substantial. We've qualified credits from some of the largest ones in the United States for multi-million dollars, again, down to payroll tax credits for startups. So it's a bit, you're doing the work already if you're coding, and you should definitely avail yourself of this opportunity from the government, as well as from several states in the United States, which have a methodology that piggybacks the federal credit. The input to the credit, the main component is wages, but also payments to contractors qualify, as do cloud computing costs. In the financial services industry, the biggest credits obviously come from the companies that have the biggest software development efforts. So that's usually quant, with teams of developers that are writing proprietary code. Bonuses also qualify. And so, of course, in fintech and hedge funds, that's a significant portion of compensation. So that's how the credits can get pretty big. Traders these days are, usually coders, and the people that supervise the coder, programmers and coders that are doing the work, and the people that support them, a portion of their wages also qualify for the credit.
Excellent. So what type of funds, you mentioned it a little bit with traders and others, but what type of funds should really be looking at this for themselves to see if they qualify?
I'm going to let Moy get into this in greater detail, but definitely quant. I mean, if you're doing anything involving quantitative research, machine learning, artificial intelligence, it's a slam dunk. I mean, you're doing R&D. Discretionary funds, I'm going to let Moy speak to that.
Yeah, so as Lewis said, the credit's really for proprietary software development, right? So the word R&D is a little bit of a misnomer, but it's really for proprietary software development. Just purchasing software, off the shelf doesn't qualify. There is an exception if you significantly, modify third-party software and integrate that into your environment. potentially qualify. Also, there are some firms these days doing some hardware development. Of course, they're not building the hardware from the ground up, but they are, in many cases, optimizing that hardware. So oftentimes they're working with a vendor to build custom hardware. This could be things like FPGAs, GPUs, even things as simple as network switches and data cards. But you're doing these kind of custom developments within hardware to optimize their network, generally for latency, the need for speed, right? But it is mostly for software. So I kind of see really three core areas where the majority of software development is done and would qualify. One area is what I would call trade execution, and this is where basically anything that's needed to carry out the trades, right? The systems that actually carry out the trades or kind of facing the outside world. This could include your trading platforms, order management, pricing engines, and outside connectivity. So this can be connectivity to exchanges, third party market data providers, and anything that actually executes the trades. A second area would be really more around quantitative trading firms, and they really need to have a separate research infrastructure that is separate from their production environment. So this is going to be for typically for quantitative traders where they're essentially looking for alpha, right? Profitability and forecasting trades, all the data analysis, how they actually simulate what's happening in the market, their algo development, and then ultimately developing the actual trading strategies. And then a third area that's really going to be common for really almost all taxpayers in this space. I think the question is going to be whether they actually buy this software or whether they develop it, in-house. But it's going to be software that's used to run the business. So oftentimes, they have a need for real-time information in this space, but it's for software that's used more of a back office function. Things like P&L, management, real-time P&L, real-time risk management, portfolio tracking, and even things as simple as compliance and reporting. So broadly, I see those as the three, core areas of software development that would qualify in this industry.
Are there any other specific areas where people may not know that, hey, I qualify for the credit for doing this type of activity or that type of activity?
So I think it's in that third bucket that I mentioned. It's a good question. That third bucket of run the business software, if you will, kind of the back office function software. Everybody has that, right? Again, the question is, are they buying that, or are they significantly customizing it at least, or better yet, is it proprietary? So sure, you can buy a lot of these things commercially. However, again, the real-time needs for this industry often doesn't lend itself to just purchasing something right off the shelf. And so in many cases, there's significant, modification needed. But I would say, more importantly is one of the things that Lewis had mentioned. It's not just the developer time, right? If you've only got 2 or 3 developers that are doing this kind of activity, then it's probably not going to rise to the level of enough material enough to really claim the credit. But typically, the operational people, the business people, are the ones actually providing the requirements to the developers. So it could be a trader, it can be somebody working in the back office, even an accountant who's providing those requirements, to the developers, and then in conjunction with that, are doing testing on the initial versions of the software. So it's really an end-to-end kind of thing. You really need to look at it from a development lifecycle standpoint, and anybody is involved. So if it was only the developers, maybe it wouldn't make sense. But when you start adding in, traders that are typically more highly compensated and business people that are involved, it adds up pretty quickly.
Yeah, it sounds like there's a lot of opportunity out there, and a lot of people may not even know that what they're doing qualifies. Maybe a couple of examples of some funds that you've worked with that have qualified for the credit?
Yeah, so I think a good example, let's give a couple of hedge fund examples. So we have for a number of years, about a $5 billion hedge fund. When we first started talking to them, they knew they had some development, but it was kind of the lower level stuff that I had been talking about, and they hadn't really considered their back office functions. They hadn't really considered their traders and their business people that are involved in providing the requirements and the specs for the software. And so the first year, which I think was 2017, their credit was only about $150,000, purely based on wages. And then now it's more than tripled, with not a lot more headcount. A lot of that is driven by trader compensation, but they're involved in this software development. So now they have about a $450,000 credit per year. And it's, a lot of it is quantitative driven. They do have the modeling and analytical type of work and some automatic forecasting and things like that. But a lot of the software is asset, class specific libraries, and then some of the back office software that we talked about. Then another example would probably be also another hedge fund client. And this is really using a data science approach to discretionary trading. We've talked a lot about quantitative trading, but a lot of discretionary traders are now using the same concepts of big data, right? That the quantitative trading firms are doing. And so they call it quantamental trading is kind of the buzzword, but it's basically using, vast amounts of data that a human cannot handle. So you got to develop programs and tools to not only intake that data from your market data provider, but then how do you synthesize that data? How do you manipulate that data and then present it and distribute it to your traders in a way that they can understand? And so that's a big area. We had a client that only had about 5, data scientists. And so if you only took the compensation of those, 5 data scientists, it probably would not be a significant enough credit, for them. But then when you start considering, okay, you have the highly compensated traders that are providing the specs to them, kind of the same, that we talked about before. And the trader compensation is much more significant. So even if you're adding, 10, 15% of a trader's time based on their compensation, that can be significant. So that credit, only based on the data scientist would have probably been about a $50,000 annual credit. But adding in the trader comp, made it about $150,000 annual benefit. And on an annual basis, it's pretty significant for them.
Yeah, definitely. And so to that note, what else should fund managers be aware of from a tax perspective, whether it's related to the credit or taking the credit? What other type of information?
Yeah, so from a tax perspective, it's actually not that complicated since it is a credit right below the line. But there is one limitation with the credit, and that's for alternative minimum tax. All CPAs know what alternative minimum tax is, but with respect to this industry, to the extent that a taxpayer, either at the corporate level or at the individual level, is an AMT, unfortunately, you cannot offset the credit. Offset AMT with the credit. There is an exception for that for small companies which are less than 50 million in gross receipts for the prior 3 years. So if you are less than 50 million in gross receipts, then you can use the credit against AMT. So that's really the only limitation. There is one actually, though, a nice special exception for small companies to monetize the credit if they're actually, not paying income tax. It's specifically for startups, and it's called actually a qualified small business or a QSB. And to the extent you qualify as a QSB, you can actually use the credit against payroll tax. As you know, most startups are in losses for their first couple of years or several years. So it's an opportunity to use that credit. And so a QSB is defined as any company with 5 or less years of revenues and less than 5 million of revenue in the current year. And then if you meet that 2-pronged test, you can actually convert that credit into a payroll tax credit and monetize it, immediately.
Well, thank you guys again for your time today, and please do reach out if anybody has any questions who's viewing this. Reach out to the Richey May team. We can get you introduced to Dave and his team, or feel free to reach out to them directly, and we'll coordinate with them on that. And thank you, everybody, for your time.